Hi guys. Okay, great. And this is question 17. And this is a slightly tidier question, not as big, because first of all, you had 5 marks for working out some ratios. So to do with some audit planning and some audit, right, let us look at the scenario. So it is currently the 1st of July, 20X5. You have a new client. I've literally written new client here because straight away, we want to get the full marks. Every time you have a new client, this is an audit risk. As soon as you see new client, it's an audit risk. In fact, in a way, the component of the audit risk here is the detection risk, right? The fact that there's an increased chance of you not detecting errors or issues just because you do not have knowledge or understanding. So I'm just throwing that out there at the beginning of this. Any question, just do not forget, if you see a new client, it is an audit risk. So what are these people? They're a small car manufacturer. This is the year end, 31st of July. First year half performance is stronger like for like. In the second year, they had some safety issues with cars. So I've written here, start thinking your analytical processes. So what you really want to do, I think for really good extra marks, is that you really literally, if you can, split the year into two and analyze that way. Why not? You can when you add the analyses together, you will still get the average ratios in depth. But good analysis wants to break it up along. All analysis is about breaking and evaluating. So breaking down. So you're not looking at averages, you're looking at individual, and we have the software for it now. So there's nothing unique about it. And the software will also give you the variances on each of those offerings, whether it's the cars, the individual cars. So you're just always trying to make your work look different for the examiner, to know you're actually looking at the work specifically. Right. So there's also the idea of a warranty, a 5-year return for repair replacement if it's not to do with wear and tear, right? So we have some other issues here. 50 customers experienced severe safety issues with their cars, not yet brought to court, but given the circumstances, they believe an out-of-court settlement is likely. I think we saw something like this in the objectives. Yes, in the objective section. The company has replaced a significant part of this production line to improve the quality of production. And so as a result, there is a significant loss of disposal. And the company has also revalued its premises 3 months before the year end. It's funny because there were so many other risks I didn't even pick up on this one. This was an issue. I definitely, and the valuation figure is used here. And so they took out a 5-year loan, which is repayable in quarterly installments. So the first question wanted you to put together some ratios. So I've done this. Again, I don't think there's anything here in terms of preparing your ratios. I'm sure you're, of course, comfortable with how to do all of these. So I've done all of these. I just had to, of course, get out my cost of sales. So you've done this, of course. Yeah, that's what you see me doing over there, working out my cost of sales so I can use for my payable period and my inventory holding period. Okay, right. So I've done that, and then using this, they want you to then, discuss a range of audit issues, a range of audit risks. Using the information provided, you could have gone a number of places. So I've highlighted, but I'm going to go to the mark scheme in the end to really stress a point. But anyway, because I'm teaching, I've just generally tried to draw out those risks for you. First time client. I thought the job was received too close to the year end. So sort of KYC compliance issues, wanting to clearly understand the resignation of the previous auditor so close to the year end. So there's sort of ethical issues in terms of timing of audit report and how soon it has to be done. So and then there's a pressure on the client. Is there pressure on the client to have this audit report because maybe they might be part of a group or something along those lines? So I've written here in terms of response, there needs to be a thorough investigation and understanding of the client as part of the planning process. I mean, you have accepted the audit, so you would probably need to spend longer time because it's your first audit. So you would need further detailed, extensive tests of detail with higher than normal sample sizes and more time planned for this first audit. Yeah, right. So I've gone with the ratios first to just look at those. the standard ones. You have potential overstatement of inventory because inventory days have increased, so possibly due to slow stock movements, potential obsolescence of stock. So that's something to look at. So again, I think with analysis, again, I've written here in-depth analysis of inventory days, focusing on the material stock inventory days. So what you're doing is you're actually looking at the individual stock items and their movements. You can actually analyze those. You can analyze the inventory days for those items, not as an average. Um, Inventory cutoff to assess pre-year end. So of course, the whole um, valuation of stock values before the year end and what they're sold for post year end to see that inventory is recognized at the lower of cost and net realizable value. So it might need writing down because you're selling it for less. Trade receivable days as well, again, has increased. So potential overstatement. This is about valuation, isn't it? Valuation. So you're really assessing the the validation or the whether or not we can actually trust the provisions that have been put. So what we see here is potential overstatement of trade receivables because we have a potential understatement of irrecoverable debt and warranty provisions. So really, we are trying to just assess. Well, after-date cash test. Sometimes these look like procedures, but in a way, you are kind of carrying out some minor procedures. What would you do? Um, so you're really analyzing warranty year on year provisions for the previous years, as well as the current year debt, irrecoverable debt provision, just to assess whether the percentage used is reasonable. There was a legal case, of course, a provision, because the lawyers have said to you that you're likely going to pay this, so we should see a provision. So we want to review the correspondence with lawyers and identify the figures they've used. Potential understatement of liability. I actually felt there was a going concern risk as well. Cash is falling. If you look at the table, trade payables increasing. You have litigation, potential litigation imminent. So we want to review a series of correspondence as well. Looking at the data, the information itself, you can see that there's the risk of the revaluation, the potential overstatement of those assets, right? Remember here. So then this is an issue. So we want to sort of review the independence of this revaluation. And that's another one, the independence of this revaluation, and also understand ethically why it was done so close to the year end. So inquire of management why this was done so close to the year end. That's another issue, of course. And also, of course, there is the presentation, recognition, and presentation. But I'm already exceeding the 5 of this loan. But now let me just come out of this just very, or maybe no, let me just do the working papers first. So, and then this was quite a standard paper. It's ironic, it's interesting because this kind of question used to be the first question. We always used to get these little 5 markers on standard knowledge, right? Oh, tell us 5 things that should be in a working paper. Um, in truth, I think you can. I mean, now you're doing this for revision, but you can almost kind of start making this up as you're going. You don't need to panic. Um, I suppose, intuitively you can think, okay, what is the name of the client? You might not get all of them. You can think, okay, the period covered by the audit. Am I testing receivables? Am I testing payables, the subject matter in effect? Am I looking at cutoff or whatever, the reference? Then, of course, we need to know who has prepared the work and who's reviewed the work. Those are the big ones. Who prepared it, dated and initialed, and who's reviewed the work, dated and initialed. So we want to see those initials. We want to see the names of the people working and doing the work. So just coming out of this, I want to come to what is extremely critical for audit, and it's here. So personally, when I do these, I don't look at the answers per se because this is a mark scheme that guides you, right? It guides you. So don't what you're trying to do is write your own answers first and then start marrying them up and getting them as close to the mark scheme, and that you get better. So key point you can see here that new audit client, but they always discuss what the actual risk is. This will increase detection risk. You need to highlight this. It's here again. This was to do with the the estimate of the warranty. This is the point I want to make. It says there's a risk of understatement of the provision. There's always this. There is a risk that liabilities are understated. This is the point, right? There's the risk that property PPE. This is the revaluation of the new revaluation that are under or overstated or whatever it is. It really there's enough. This is the one I was talking about, the revaluation. There is a risk that there's misstatement or the potential overvaluation as you read it. This is what I talked about, inventory days, if you like. So you can see this is about receivable days. I don't know where you go. You can keep going, but feel free. There's more than what you need. But you're trying to always hit that punchline on what the actual effect or the consequence is. Awesome. Great stuff. 17. Question 17.